Welcome to the Financial Thought Exchange podcast of the CFA Institute Research Foundation. This is where you learn from the leading thinkers in finance. I'm your host, Lotta Moberg, and my guests today are Petter Kolm and Gordon Ritter. This is our second conversation about reinforcement learning and inverse reinforcement learning that we'll get into today. So if you haven't heard our first conversation, I recommend that you go back and listen to that, where we cover some of the basics. And today we're really going to get into some of the applications as well as some areas of reinforcement learning that you may not have learned about before if you ever heard about this field. So anyone who's listened to our first conversation know that you are a wealth of knowledge in this field. And now we're going to get into some of the other technical aspects of this, as well as a lot of the application of reinforcement learning generally that I think will be useful for the audience here. So let's dive into, maybe start with you, Petter, about reinforcement learning. There's also the aspect of inverse reinforcement learning that you introduce in your chapter. Maybe you can give an overview in a nutshell of what we're talking about with the inverse part here.
Quick recap about what is reinforcement learning itself. It is a very general machine learning algorithm or set of algorithms that allows us to make sequential decision or solve sequential decision-making problems. I'm observing the environment, and I'm learning based on the information that I receive from the environment what constitutes the right decisions based on some reward or some cumulative reward that is computed over time and given to me as the feedback. When it comes to inverse reinforcement learning, it's not quite reinforcement learning upside down, but it's essentially the notion that I'm now observing, besides the state, besides the environment, I'm also observing now the actions that are taken by some person or some actor. It could be another algorithm, right? Or it could also be a person. And now, based on that information, I want to back out what is the objective or what is the reward function that that algorithm or that person is making decision based off of.
So as an example in real life, would that be, we see everybody rushing to the train just as the train is taking off. What would be their goal here? Oh, it must be that they're trying to catch a train to get somewhere. And from there, now we're taking the next step in how do you best optimize so that you can get on the train on time.
So exactly, right? Inferring behavior. What is it that drives behavior based on the actions that you are observing or seeing? Correct.
Yeah, interesting. So Gordon, maybe you can help us give a couple of examples of when in finance, what would be applications for this when this kind of approach is useful?
Sure. Yeah. So as we talked a little bit about in part one of this podcast, in reinforcement learning, we have the classical RL setup is that we have a sequence of rewards corresponding to individual time periods, and the problem then is to derive an optimal policy. And so the output or the product that you get from RL is a policy, right? A policy is something that describes behaviors given a certain set of incoming variables called the state of the system. What behavior would the policy predict or recommend? That problem kind of also feels classical in finance, where there's a ton of finance models, like going back to Merton, the Merton lifetime consumption model, where essentially the output is a policy where it tells you how much of your wealth you can consume versus invest at different stages of your life, and there are modifications of it where you can have an amount you bequeath to heirs, and you can have a utility function of consumption. So inverse reinforcement learning in finance is essentially, instead of starting with a known reward signal and then the output being the optimal policy, which describes a behavior given any conditions, right? What you actually have is a set of behaviors. And then the inverse part is to go back into what was likely the reward signal that such that those behaviors would be viewed as optimal. It's often used in the context of experts, right? So, for example, if you have a set of behaviors that you can observe, that you have observed, and that are viewed as coming from an expert and hence presumably good to emulate, but you don't know what reward signal led to such good behavior, inverse reinforcement learning techniques can then come in and tell you this is likely what this person was trying to optimize. So, I mean, a good example in finance that's faced by large wealth managers is to understand an investor's utility function, right? So, what is their utility function of consumption? If you knew it, you could apply a Merton-like framework and then tell them, okay, well, here's how you can optimally invest for the rest of your life and retirement, if only you knew their utility of consumption. But if you can observe their actions up to now, can you get some at least partial information about their utility of consumption and then give them better advice?
When might this, so it sounds, it's very logical, and it also sounds like it can go wrong in the sense that I can observe somebody doing something. Right, I can walk into a disco, right, and I see people jumping up and down. I'll be like, "Oh, they're trying to maximize their calorie excretion," and it turned out that no, they're actually just trying to have a good time. In finance, what could be examples of when you can maybe get the behavior wrong, that you're observing something when the goal is actually something else?
It's absolutely right that when you're dealing with the inverse reinforcement learning problem, where you're trying to learn what is driving a particular behavior, it's often an ill-specified problem. There can be many different kinds of solutions, and that leads to exactly that same behavior. And now, in finance, a typical way, very simple way, could be if I know a class of utility functions, to figure out what is the class that this investor belongs to and what's their risk aversion, right? That makes the problem very very nicely specified, and it's in some sense a model-based inverse reinforcement learning problem, because I'm already assuming a certain class of utility functions. Uh, but at the end of the day, it comes down to this whole question of learning behavior or preferences, right? Can I learn the preference relationship that someone might have for doing one thing versus another?
If we take an example, you mentioned high frequency trading as an application. If we can step through that as an example of how the inverse reinforcement learning might work in an application like that.
Sure. So in a high frequency application, right? That's what is it that I'm observing? Well, maybe I'm observing a sequence of rapid trades, right? Maybe I'm also observing all the orders that were sent to the order book, and maybe I'm also observing the entire order book for this particular stock in itself. So the state would be described by the order book itself throughout time, right? That will be a characterization of the state of the system. And the actions would be the various orders that were sent. And then I could also calculate, then based on which ones were filled and what prices that were filled at, I could calculate the resulting the P&L over the period that I'm observing. Now, I could now ask myself, so given that I'm observing all this information, what led the trader or the algorithm to execute or send all these different orders, right? That is essentially what we're trying to answer. Now, when I post it like that, it's immediately clear that it could be based on a bunch of different things, right? So if we're putting our finance hats on, we could say, well, that's going to depend on the kind of trading strategy that someone has. Absolutely, right? The kind of forecasts that someone has. It's going to depend on also the system that I'm trading with. Do I have a fast rig or not, right? It's going to depend on how I'm looking at risk and trade-off and risk aversion. It's going to depend on things how that trader is evaluating the order book, things of that nature. So again, it's a tough problem to directly infer all of those sorts of things, right? But inverse reinforcement learning gives us tools where we can learn at least some of those aspects, observing the order book and observing that sequence of trades.
And how relevant then is this for practitioners? That either you can take this in the sense of it sounds like more like an academic exercise, but I know it's not only that in terms of I can understand why people behave in a certain way. But is this also a way for me to say, I don't know anything about high frequency trading. I'm just going to or I shouldn't say just, but I am going to put my inverse reinforcement learning model on top of this and just try to kind of mimic what I'm thinking they're trying to do a little bit like everybody's running that direction. I'm just going to run that direction and I get a good result because
Sure.
they seem to pursue something.
Sure, sure. Uh, there are a number of practical applications. I think one of the more important ones that have now also been used in industry for a while, and we discuss in our chapter, is that of robo advisory, right? So imagine you're one of these robo advisory firms, and you're managing tens of thousands, if not hundreds of thousands, of accounts for retail investors. Now, you are, as a robo advisor, your task is to design a portfolio that is suitable for that individual. Now, what does that mean? Right? It means that in some sense, you should be making decisions that are commensurate with what those individuals want, which, as a footnote, is sometimes questionable, obviously, because many people that invest in robo advisory don't know much finance, and that's one of the reasons they are going to a robo advisor. But inverse reinforcement learning can look at behaviors of individual investors and learn the objective function, the decision criteria that they might use to make such decisions. So that's been used by a number of robo firms to infer that sort of behavior.
And I would add two things. One on the point of pitfalls. Typically, the way these systems are implemented, the system, like under no conditions can the system do something sort of like crazy or really wild or unwarranted. It's really just a question of the system is being tasked with selecting from among a menu of actions that are all reasonable, but some are presumably closer to that investor's preferences. As long as it's architected that way, it's sort of like you're within a kind of a safe system, and the only question is which of these various safe options is more palatable to this person based on their past actions. An analogy that kind of works here is if you think about driving again. Reinforcement learning is used to produce self-driving vehicle systems, and to the extent that humans have to ride in these self-driving cars, if they're taxis or something like that, well, a human, for example, might not be comfortable, in a car that's constantly using reverse all the time, even though a machine with cameras all around the car doesn't care, right? So, by observing the behavior of human drivers, that they kind of only use reverse when they absolutely have to, in parking lots, for example, then you would actually learn a preference function that would never come if you just thought about the problem from a pure machine robot physics. Well, a robot doesn't care if it's going backwards. A human does.
So the point, if I understand you correctly, you're making is that there's still, in the sense, guardrails in that I'm saying, look, where we're trying to figure out what this investor is trying to do, and we started talking about, by the way, to clarify for everybody, we talked about high frequency trading, but now we're really talking about long term, steady, like nothing really really fast. So this is very much in line with what a lot of our listeners may be used to in terms of
Yeah.
wealth management, whether they're clients or not, and so we're basically saying, I'm not talking about any goals. It's goals within these. I'm setting some guardrails here, how you can think about this. Like you can't observe somebody saying, let's say, investing, and then concluding that they're not spending a lot of time on this. So probably they don't want to spend any time on it, so let's just not do anything or something like that. It's still like in the package of investing and reaching certain goals within
Yeah,
that.
for example, you could imagine, well, our system always produces something that's, Merton optimal with taxes or some discretization of Merton optimal. But the only piece that we don't know is a sort of well, how much do you really prefer consuming wealth versus investing? And in a range of reasonable values of that parameter.
So how much should you, if you have then a inverse reinforcement approach and you see how other people are investing, is this a way to just kind of do what other people are doing? It sounds like there's there's risks that go into it because you mentioned in asset management too. So I'm managing money for an institutions, and I can observe others and I can free ride on others' behavior and infer their goals and maybe do the same. But that's also comes with some risks, it seems.
I think one of the ways it's also been used, right, by robo advisors is if I infer if I'm if I'm inferring your trading decisions or your investment decisions based on your past actions, I can also educate you how to do a better job. So, for example, I can see or I can learn that there is really no systematic aspect to it. It so happens that you decide to trade whatever was on the news that Friday afternoon, and you happen to
Mm.
put a trade in with your broker after you've gone, for Friday drinks with your friends. Right? That's a bit of an extreme tongue-in-cheek example, but by looking at people's behavior and also then seeing that there isn't a thought process behind it, we can try to steer them towards making more careful decisions.
Like on average, my actions tend to veer towards a certain return and a certain maybe Sharpe ratio because I care about risk too. And all of a sudden, I do something that is completely out of line with that, and that's when you can say, there's something that's not fitting into your kind of decision pattern here.
That's right. I mean, investing is a big problem. It's a tough problem for people to grasp, right? What is it that I should be holding? At what point in time should I be holding? How much should I be holding? How should I manage risk and trade off between risk and return? One of the key things that we know from retail investors is that the majority of retail investors, unless they're just trading a portfolio of ETFs, is that they're holding too few assets. They're not holding diversified portfolios, right? They are often very concentrated in just a few stocks. So now, if we can educate them towards more sound practices, such as that of diversifying, that is very helpful. Now, would we use inverse reinforcement learning to back all that out? No, we can obviously see that, right? We can see that directly from their behavior. A human can observe that, but inverse reinforcement learning it can learn or can analyze many different kinds of behaviors and extract out very general recommendations for changes.
So maybe we can get into a little bit of the possible drawbacks and when this can go wrong. And here I'm talking about both reinforcement learning and the inverse reinforcement learning, like we've been talking about. If people think about it as you use a lot of historical data or whatever you observe, it's always going to be something that is per definition already happened. Um, does that mean that these models maybe miss things such as there's a financial crisis that is triggered by something that we haven't come across before? Is it one of these? Because there's a lot of models out there, right? That people know that it doesn't. Tries to kind of model the prior crisis, but doesn't really know what might come down the road.
There's always that notion of whenever we have a model, whether it's completely quote unquote model free, like a reinforcement learning agent that just learn from data, or it's a model based model. And it's these are algorithms, right? I like to think about them as algorithms, where algorithms is some computational framework. That's one piece, and the other piece is what is the data that it's been trained on, right? So these algorithms, right, or traditionally we often say models, right? But models are typically the parametric specification, the structure of the equations we're using, but the data is now also super important. So, so all models or all of these decision-making algorithms, they're wrong, right? They're not perfect descriptions of reality. And as you're pointing out, reality does indeed change. And one of the things we're interested in finance is to build models or build algorithms that can adapt to these changes, and ideally adapt to these changes faster than more traditional frameworks, right? And they can learn over time by observing the data. Oh, based on the data that I'm seeing right now, I'm in a different regime. So I should now change the way I'm doing my trading or the way I'm making the decisions. Of course, a data driven modeling framework or a data driven algorithm, it needs to learn from the data itself. What is the data that we're feeding the algorithm? And there's essentially two choices there, two main choices, right? And that is one, I can feed it historical data, and we talked a little bit about that in the previous episode. That if we look at a history, that's just one path of essentially a random process that we don't know what it is, right? So we often in machine learning applications of the kind that reinforcement learning is, just that historical path is not going to be enough to train a reinforcement learning agent. So what we do in addition to that is we also build simulators. So these are going to be obviously simulators that simulates whatever we are interested in, right? But of course, there's going to be assumptions that go into how these simulators are built, right? How is this data now generated? And of course, it could be a more traditional stochastic modeling framework, or it could be another machine learning framework that's also learned from data itself, right? So while these tools are useful, the caveat of this, of course, is that the resulting algorithm I get is only going to be as good as the data that I have trained it on, whether it's historical or whether it's simulated data or a combination of both.
I mean, I would add that a huge weakness of these models generally is that, how much were different states visited during the training process. Okay, so there could be a corner of state space that the model didn't spend almost any time on during the training. And then so as a result, and if it learns primarily from experience, then it can essentially have no experience for a whole corner of state space, right? So one example of that could be that's very relevant to financial crises is in finance, we see these periods where, colloquially speaking, all correlations go to 1. Suddenly, a bunch of assets that were previously thought to be uncorrelated all have their worst tail event and all at the same time. And so you could think of that as a particular corner of state space that's unlikely to be visited. It's sort of crucially important that if you're training a model that's supposed to be able to handle crisis-like behavior or behave reasonably through crises, that it should have been trained on simulations that visited. I mean, even if there is no such situation in the historical data, it could happen, right? So they need to be trained on data sets that, at least in simulation, have visited those cases where all correlations go to 1. And another giant kind of weakness or pitfall of these models is that. So yes, we have theoretical convergence results in certain situations, but the models are never trained to convergence. They're trained until some point where they stop or some learning rate parameter goes away. Or if the learning rate's constant, then you're constantly injecting noise in. And so the point is then you end up with some policy that makes decisions based on a function, and the function typically used to choose actions is called the value function, or the action value function, which is literally given an action, what is my expected long-term gain if I take that action, and it tries to optimize that. Now, once your training process is done and you have a policy or an agent, what I typically do is, for example, you could plot the action that it chooses as a function of each one of your state variables. So if you have 10 state variables, you basically have 10 plots or a plot in a 10-dimensional space of, the action as a function of the state. And does that make sense? In some cases, for example, if the agent wasn't trained enough or didn't visit enough corners of state space during the training, then you could see that there are actions that you could even see with the human eye don't make sense. Like, a signal gets even stronger, but the trade is weaker. Things like that, or if a certain function should be monotone, you just don't know what the function was, and then you can see the learned value, and it's not just increasing. So those are all massive pitfalls, and I think that's kind of like what you get in. So what you get is something that can deal with cases that can't can't be solved analytically. But one of the costs you pay for that is you have to be extremely careful of those kinds of, models that essentially haven't been trained enough, don't have the experience in certain types of states.
So you're basically saying that some analytics should always be applied to some extent. Like to your example, I have some variable and I see that the reaction should be positive, and then it starts going down at some point. That might
Exactly.
be an interaction with some other variable that just doesn't it doesn't chime with intuition.
Yeah, well, and I mean, it could make you could understand perfectly well why it would start going down at some point, because those points are very unlikely to be visited if you just simulate a whole bunch of data, and it's never seen that before. So how would it know how to act if it's only based on experience? And this is something that maybe doesn't get talked about enough. What's the validation procedure that's applied between when the policy is trained and when it's actually used?
And then another thing that people might be hesitant when it comes to these models that I wanted to ask you about, either of you, of course, is the transparency of it. So I get a result, it now is doing something on my behalf. How transparent are these? I do understand there's a lack of them. How do we understand that? Like, how severe is that in terms of black box kind of thinking?
It's very closely related to what Gordon was just discussing, right? Is that we fit a model, we fit an algorithm, we learn a reinforcement learning agent, and now we want to ask ourselves, is it doing the right thing? And that leads to these questions of interpretability. Is it interpretable? Can I look at it? Can I take it apart? Can I understand what's going on under the hood? And somewhat related to that also would be questions around governance around these sorts of models. Now,
And can you generally do that? Is that we did take the example with Gordon here, right? Like you can see how the variable is connected to the outcome, but can you always see that? Is it transparent in the end?
so and I think well, let me step back a little bit and sort of contrast two modeling frameworks, right? That of a fully model based where I can get a closed form solution, right? Then I can look at it if I'm mathematically inclined, I can look at the equations on a piece of paper and I can say whether this makes sense or not based on my knowledge of that subject, right? So the one of the reasons why people like analytical solutions is that we can take them apart, right? And often what you see also in traditional quant finance is that even there some analytical solutions are very complex to understand. And then what authors often go at length at doing is to look at simplified versions of those and take those aspects apart to demonstrate that, well, look, if we look at it from this perspective, let's just consider the one asset case, right? Then this is the solution, and this solution makes sense, right? That gives people comfort, and we're used to that, right? This is traditionally the way modeling has been done for decades or even centuries. Now enter machine learning models, and I'm speaking now more broadly, not just reinforcement learning, but also machine learning in general. We have a computer algorithm, right? We're fitting a bunch of different parameters on some computer algorithm based on data. Now, can we look at the computer algorithm? Yeah, it's right there. We can print it out also on paper, right? We can see it. It could be 100 lines of code. It could be a few thousand lines of code. Can I look at the data? Yeah, here's the data that was used to train, right? But it doesn't mean that it's that easy to interpret. I can see the parameters also, right? Imagine looking at a deep neural network that's been trained and I have a few billion parameters. Yeah, I can look at all of those parameters, but they're not going to tell me anything. So part of the this demand for interpretability and explainability is because we like it that way, and it makes sense in many cases, right? At least in the simpler cases, to say, okay, does this behave or does this make decisions in the way that I would more traditionally do? But when we go in the direction of using machine learning algorithms, we need to get comfortable with working with models where we cannot take every single piece apart in the traditional way. Now, that said, there are many things that we can do, right? We can still, like we do traditionally, we can still analyze these machine learning models in simpler cases, right? I can ask myself, for example, I trained this reinforcement learning agent that Gordon was talking about, and let me see what decisions he would have made in this aspect during the financial crisis. And do these
Mhm.
decisions make sense, right? Uh, and part of that could now be, well, has the reinforcement learning agent, while it was being trained, did it see similar episodes, right? Yes or no. If it did, then maybe it will make the right decisions. If it didn't, and still make really good decision, it means that that model has generalized well, right? So applying these sort of essentially what if type of analysis, that's one way of taking these apart, right? In some cases, as Gordon was also alluding to, you can also look at your you can look at your policies as function of your state variables. But again, if you have very large state spaces, right? Even Gordon likes 10-dimensional state spaces, and he can visualize those. That tends to be tricky for many of us, right? I'm happy if I can visualize something beyond the 3 dimensions. That's a tongue-in-cheek answer, but you get the point. There are ways in which we can take these things apart, right, and simplify and check, but it requires different thinking, right? And I think that many people in industry now are at the early stages of learning how to work with machine learning models. How we test them, how we check the features are okay, that things do make sense. How much interpretability do we need? One very simple check is going to be, in most cases, right? It's going to be a traditional model that we're very familiar with. So now comparing what a new machine learning model, what decision does that machine learning model make vis-a-vis that of the traditional model? And are they somewhat in the vicinity from each other or not, right? That question is going to give me comfort around using this other framework or not.
So there
Yeah.
is the concept of explainable AI. Is that kind of what we're getting into here? And Gordon, I'll let you cover this. Make sure that we're also understanding like what's the explainable AI framework too, because you mentioned that in your piece.
I mean, and this is directly expanding on what Petter just said, but I think a basic check that everyone should do is typically if these models, if these methods are being considered in the first place, it's because we have a problem we want to solve, and there isn't a clean, analytically tractable, closed form solution to it. But there typically is to a simpler or more idealized version of the problem, right? So take, for example, option hedging. In the real world, it can be messy. Trading is discrete and expensive. Then we have an idealized version of the problem that does have an explicit solution. Pick your favorite, closed form option pricing model. Okay. So now for example, Black-Scholes, right? So in the Black-Scholes world, if your training system is worth anything, it should find the Black-Scholes hedging as the solution. And so if anything, I think there's an increased, I think, need for analytical solutions to models. And then that actually provides like a very strong layer of validation and explainability, right? So you can then say, in the Black-Scholes world, this thing does exactly what you think. And then the problem we're actually trying to solve is, a small move away from that there is no analytic solution for. But by the way, we might have an idea of the direction, right? So if we introduce frictions, trading becomes more costly. Well, the trading should become slower. So often you're in a situation where there's an analytic solution in an idealized world, and then we have we're trying to take a gradient step away from that to a real world problem, and we have already a notion of the direction that step is. We just don't know the size, if you like. We can't compute the exact hedge ratio with a sufficiently gnarly, transaction cross function, but we have an idea of the deviation it's taking from the explicitly solvable model. And, financial economics has, literally thousands of these situations where people took a slight idealization of the real world and, they took exactly the idealization they need so that they could explicitly solve the system. Every one of those situations presents an opportunity to now try to remove the idealization But first, you should always prove that your reinforcement learning methodology, your training system, is doing what you know is optimal in the case where you know it, right? In the idealized world that the explicit solution was derived in, we know what it ought to be doing, and it's sort of an obvious check or unit test before going any further. If it can't reproduce what you know is optimal in a known controlled environment, then you have a bug.
Yeah, no, that's very helpful. So, like you said, the benchmark becomes like this model that so you have a good context from there to then interpret how just a little bit different from that stylized model that we're trying to optimize here.
Yeah, which then makes it explainable, right? Too. Again, when it comes
Exactly.
then coming to explainability, we can say, okay, now we're doing something like this optimal hedge, but in a world with frictions, we're moving away from that in a kind of a controlled way, and we need the machine's help on this last bit.
Yeah, no, that's excellent. Thank you so much. I've learned so much from talking to you both, and I'm sure our listeners have as well. And they're eager to learn more and get started. Would you, to round this off, maybe, would you have any suggestions of where people go to learn more, to get started and learning more? A lot of our people in the audience here will be financial professionals, but they don't necessarily have any experience in the reinforcement learning.
I strongly encourage everyone here, if you haven't already, downloaded the handbook out of which this chapter is coming. Go to the CFA Institute's website and download that and learn more broadly about how machine learning can be used in asset management. And you'll learn a lot of different tips and tricks, including that of reinforcement learning. One of the emphasis that we put on the chapter was to try to tease out the basic building blocks intuitively. There are very few equations. There's some for the ones of you like equations. There's some, but it's to understand a little bit where it does indeed fit in. You'll also find a number of citations that by now are classical textbooks on reinforcement learning, such as that of Sutton and Bardo. And you'll also find citations to software, just like other machine learning areas, such as supervised and unsupervised. There are a number of different libraries that are available for RL that can get you up and started relatively briefly. And Gordon, maybe you want to talk a little bit about one of the examples that we have in the chapter that we have also implemented, where we make that full implementation available.
Yeah, so we did submit some source code along with the chapter. The goal of that source code was not necessarily to be extremely state of the art or close to the bleeding edge. The goal was also not to present something that people should just immediately go use to trade or anything like that, but to sort of provide a starting point, because often that's, once you get started, that's the hardest part. In that sense, we kind of illustrated. So in one of the simplest possible models of trading is mean reversion. Okay, so it's a buy low, sell high idea. If you can construct some basket of assets where in combination they sort of revert back and forth around an equilibrium, then there's a well-known trading strategy that you can build around that. And as we were saying, there's analytic solutions. Now, our source code that goes along with this, it shows how to get started on that kind of toy model, I would say. The framework is PyTorch, and specifically some PyTorch libraries that were created, I think originally by OpenAI, although I think some of those libraries have now been open sourced and are continuing development by the broader community. But once again, I would particularly lavish some praise on OpenAI here for having been fairly open over time around publishing both source code and Python frameworks and also white papers and blog posts and things like that kind of explain what they're doing. Obviously, it doesn't get to the very state of the art like the latest ChatGPT, but it's extremely useful for constructing these relatively simple trading environments.
Thank you both so much for being here. I hope our audience also enjoy the wealth of Swedish accents in this panel. And I really appreciate you both taking the time both to write this chapter, obviously, and to be with me here today. So thank you. Thank you, everyone, for tuning into the Financial Thought Exchange podcast. My guests today were Petter Kolm and Gordon Ritter, who together with Igor Halperin wrote a chapter on reinforcement learning and inverse reinforcement learning that was part of our recent AI in asset management publication. So thank you so much for listening. This was the second out of 2 conversations. Make sure you listen into both of them, and we will see you again soon.
For more information, please visit rpc.cfainstitute.org/research-foundation.